everyone. I'm Alan Beaulieu from ITR Economics, and this is this week's Fed Watch. I'm filling in for my brother Brian this week, and I know he normally does it and does it superbly, but I'm going to do my best. Let's talk to you about the Federal Reserve Board in a different vein. I had the pleasure of being at the SMU Steel Market Update Steel Summit in Atlanta this week. And one of the questions I got after the presentation was about an economist, and we don't need to go into who said that the inverse yield curve was a false signal. And because from listening to ITR that we think the inverse yield curve is very telling in terms of what 2024 is going to look like. We never said it was going to have an impact in 23, but it will have an impact late this year and in 2024. I'd not heard of this fellow's statement, and in doing some research, he made the statement in February that the inverse yield curve was going to have no impact on the economy, everything would be just fine. And then come June, he changed his mind and said that it actually meant we were going to be in for a deep recession in 2024. Well, we've gone through the reasons why it won't be a deep recession in 2024, or at least not yet. Based on what we see, businesses are, profits are at a high level, although the rate of change is coming down and profits are certainly not continuing to climb. Delinquency rates are low and bankruptcies are at a low level, though they are increasing. Consumers are pulling back some as inflation's taking its toll. Interest rates are taking their toll. So all of that's going to lead to that recession we're talking about. But I want to take it from another angle today. When the gentleman asked me the question, my response was, that doesn't answer for the quantitative tightening that's been going on. Now, just to refresh your memories, quantitative tightening is when the Federal Reserve Board implements monetary policy that contracts or reduces the Fed balance sheet. The impact of that is it removes liquidity, money, from the financial markets. So businesses and individuals have less cash available to go borrow from their local friendly neighborhood commercial or commercial bank. And it's evident. And how is it evident? Well, there's a thing called the availability of consumer loans. And the availability of consumer loans, which we're a nation of borrowers, that is well below year-ago levels. So the availability of money is 21.8% below year-ago levels. Now, let me put that in context for you. It was a lot worse in 2008. In the middle of that financial crisis, which was followed by, that was early 2008, which was followed by a very serious recession, consumers had no access to money to speak of. Now it's inconvenient, and certainly those with poorer credit scores are not having access. Maybe even some moderate credit scores are not having as much access or being asked to pay a much higher rate, so they're deciding not to. But it is having an impact on consumer borrowing, and that has an impact on economic growth. And then there's another measure, which is the U.S. net percentage of domestic respondents tightening standards for commercial and industrial loans, which is quite a mouthful for large and medium banks to finish it off. So this is a Fed survey. And as the Federal Reserve Board does this survey on a more or less quarterly basis, they're looking at domestic banks, 60 of them plus or minus, and some foreign branches. And they're asking them, what's the tightening going on? And at the moment, 50.8% of the respondents said that they are tightening. Now, let me put that in context for you, too. That's been going up for a while, but it started to go up at a much more noticeable pace, rising at a faster pace in the second quarter of 2022. Why is that important? Because that's when the Fed started to raise interest rates, the Fed funds rate. So what we're noticing is that quantitative tightening, which began at about the same time, is causing banks, commercial and banks, to say to large and medium businesses, you have to qualify more. You need more money down. Your credit worthiness is now not the same as it was. We don't have as much money to lend, is what they're not saying, but that's what's going on. And it's exactly the same thing, almost the exact same number, 49.2% for small businesses and the availability of money. So again, it was much worse in 2008 for small businesses, but we've gotten to the level where it has an impact on business spending. It will have an impact on business spending as we go forward until quantitative tightening ends and quantitative loosening begins. that's going to bleed over into 2024. And as the increased tightening in the money available to businesses and individuals continues, that feeds into that recession scenario. So the Fed has two levers that they're working: interest rates, which gets all the headlines, quantitative tightening, which works behind the scenes, but it is having an impact. And as Brian has often said, not expecting the Fed to lower interest rates in 2023. If it goes a lot further into 2024, that puts our 2024 timing of the low for the recession at risk. If quantitative tightening continues and starts making me nervous in terms of the height and reaching towards the 2008 level, that's certainly going to signal a much more serious 2024 downturn. We're watching it for you. At this point, the forecast is good. We're right on target. Thank you for joining me today. I'm Alan. This is the Fed Watch. See you next week.